All right, so let's start right there. The drama that we're seeing in D.C. right now, any impact on the market, especially given the fact that we are seeing major averages take a breather this morning to start the week?
I think that investors are certainly concerned about what's happening in Washington. We're all concerned. I think that we're in a very unprecedented situation with the level of violence that we saw at the U.S. Capitol. And the reality is that if these violent confrontations continue, which is a possibility, that could be significantly disruptive to the economy as well as to markets, not to mention the need to control the COVID-19 pandemic. So, yes, it is absolutely troubling.
Yeah, and of course, one of the other big stories that emerged over the weekend and into today, and certainly some of the names under the greatest pressure, are these big tech names that I see are within your portfolio, whether it is Apple or Amazon or Google or Facebook. I guess, how are you assessing those names, particularly from a business and potential earnings standpoint, as an investor, given everything that we're seeing play out and what that could mean in terms of, I guess, both ad dollars and user metrics?
Well, the reality is that for the advertising-driven technology companies, Google and Facebook in particular, I think that the underlying fundamentals of those businesses are actually quite strong because people have moved online in terms of their advertising and desire to connect with their audiences. And, I think most people don't understand that political advertising is actually a very, very small component of what drives their top line. And they have been under pressure for quite a long time from investors as well as other stakeholders to do a better job at content monitoring. And I think that they were simply basically backed into a corner, given recent events, to take the steps that they did.
Valerie, on the jobs number Friday, obviously somewhat discouraging, but it's been pointed out over the course of the weekend as people dug into the internals that it was kind of sector-specific net. And if the argument goes that you beat COVID, you save the economy, that's leading to narratives that say you could be looking at a boom in the second half. Is that sort of your base case?
I think so. I looked at the numbers pretty closely, and there are significant variances by industry and sector. What you saw is significant weakness, as you would expect, in hospitality and restaurants and those types of services that have, quite frankly, been forced to close again because of the upsurge in the pandemic. But there's real strength in retail trade. There is strength in warehousing and transportation. There is strength in a number of areas that imply that the economy, the underlying economy, is actually improving. So I think that once we get past the COVID pandemic, that we could be looking at a brighter future ahead. And I think that's really what the market is pricing in right now.
Yeah, I think along those lines, in terms of that discussion for 2021, is the interest rate discussion and what we're seeing in the Treasury market right now. What is your outlook for 2021 as we do see an economic recovery, I guess, take root and potentially move a lot stronger, a lot faster than had perhaps previously been expected?
Well, I think that the Fed has been pretty clear in terms of signaling that we'll probably have lower rates for longer, and I don't anticipate that will change anytime soon. So I think that the market is pricing in, a low interest rate environment for the foreseeable future. And we have to see how long it takes for the fiscal stimulus to actually kick in, so to speak. So I think that interest rates will probably be low for the foreseeable future. That's my outlook right now.
Shepard Smith here. Thanks for watching CNBC on YouTube.